Hello everyone and welcome back. In today's video, we cover stock, commodities and crypto markets right now and look at the key levels that we need to be watching over the next couple of days into the next few weeks. The rallies that we've seen in the stock market have been significant, and that's actually across all asset classes. The problem is every previous rally this year has been met by brutal selling demand, and that means that the bears could be coming back very, very soon. There are some worrying signs that we're starting to see in these markets, but there are some also areas of hope moving forward. The key at the moment is really to have the patience, the reaction, and necessarily don't predict. We need to be always looking at this market from the standpoint of putting our hard-earned to work at the correct levels. Let's talk about that right now, and we'll see you very soon. Stay tuned. Well, welcome back everybody to the channel where we talk daily about stocks, commodities and cryptos. We'll be covering the macro environment, then going into, of course, the charts and even more later on. So stay tuned for all of that. But let's get started with the heat map. It was a middling day, which means basically the market didn't really show any particular signs of strength, nor did it show severe weakness. It had a rally in the pre-market session. Often the Asian market and to the European and London market will turn a little bit green or bullish into the Monday kind of euphoria. It follows from that Friday period, which was very, very strong, but it then dropped immediately, had a little bit of a resurgence into lunch, and generally speaking, it was down. And of course, the Nasdaq was the leader of the decline, 0.81%. Interesting because Nasdaq has been holding a little bit better than the rest recently. This was the first day we've seen some little bit of weakness here from the Nasdaq compared to the others, and that's probably through profit taking, possibly from the street itself. Let's talk about the best sectors for the day: energy, solar, metals, utilities, healthcare. Utilities and healthcare, you'll notice I paused on those. They're usually defensive sectors. Suddenly they were doing a little bit better, plus XLP, consumer staples, was doing a little bit better. We'll talk about that more very, very soon. But let's also discuss midterm election years. A lot of people lose sight of all the problems we have right now in the markets. Inflation, the Fed, obviously the war in the Ukraine and Russia, and all of this stuff that's going on in the world, supply constraints, everything. But we also have the midterm election years, and they tend to also spike volatility in the back half of the year. And the reason I bring it up is because the worst may not be over yet for markets. If we look at things like second year new Dem Pres years and first term midterm years, they both tend to follow a very similar scenario. Obviously, we've seen some of the turns like this happen before. We did have the March turn into the beginning of April, but we never got that last rally. And what are we seeing right now? Are we seeing a late June rally into the beginning of July, but possibly we don't see any of this previous July back end into August rally? Well, that's certainly a very interesting scenario. The other thing that we tend to do is in both of these times, we tend to either bottom off or we make a new low, and we get very close to that low again in those other first term, midterm years. So if history is anything to go by, it would say that probably we're going lower and volatility may not be ending here for 2022. It's something we've talked about on the channel all year. We knew this year was going to be the year of the trader because of all of the bad things that were occurring at the end of last year, 2021, and also this just general stats that tend to go into these midterm elections. Let's have a look here at a bit of a report from Bank of America. This is the credit and debit card data coming out up until June. And you'll notice that it's the big ticket items that are getting hurt the most. Furniture spending year on year dropping considerably over the last few months. Considering this, what that means is probably collectibles, also used car data, which we already know, and just in general new cars and everything probably will be dropping. People are tightening on the top end, which always is where it happens. The luxury, the things that are a little bit more harder to buy and more to save up, and people are spending still on the bottom end of the market. Just keep this in mind for any other FOMC event. This is generally the way that markets will run, and it's usually rallies that occur off it. FOMC, we get a little bit of a rally drop, and then we often base. Obviously the FOMC over here. Then we also have the previous FOMC events and what's happened there. We've got those rallies from those points. So it's interesting to see that if you do think about it, every time the FOMCs come out this year, we've generally rallied off that moment, at least for the next session, if not for a couple of days into a week. So just keep that in mind whenever you're looking at charts in the future. We do know also that the net selling or the net purchasing by asset managers is at an all-time low. I've shown this chart a few times, but it's so important to bring up. Asset managers here purchasing net, that is net of shorts and longs, at the lowest rate that they've done so really for many, many, many years, much lower than it was during the 2020 pandemic. And this means that really they're still net kind of shorting by their general book. Until this switches, investors beware. Make sure you follow the channel here, because we will be talking about if we ever actually see this switch properly. But at this stage, we're just not seeing Wall Street picking this up. In fact, every time these rallies happen, we are seeing an additional short coming through from the street. This weekend's video, I said this on the live stream, which we do every Monday here on the channel for the pre-open. I said that this weekend's video could be massive, because if we see Wall Street doing something, we might have a little bit of an edge on what could be happening next. Back-to-back weekly declines. This is from how we got to this point. The data was pointing towards the first and second week being so bad. Usually 1 month after that, we tended to have a fairly positive market. This is where we are right now. Remember, we're 1 and a bit weeks into this already. So technically, the bullishness played out, the stats played out. Just keep that in mind. The 3 months becomes a lot more questionable. And this is something that I think everybody's got to keep in mind. A lot of the times when we had these back-to-back 5-week declines, we got the dead cat bounce, and then it ended up going quite a lot worse 3 months later. Keep that in mind moving forward. We also have the midterm election years. I think that whatever happens at the end of this year, if it keeps getting worse and worse and worse, there are going to be points in this market that particularly investors and traders alike will be looking at based on stats. If you buy the right area, the next year after midterm election years can be quite good. And I do know there's more than, of course, just the midterms, but there's still some interesting data to bring in here to the charts. Let's talk about VIX and volatility, 26.96. Now, we've had this come down to 25 a few times now, and that's been the buying zone for VIX in terms of the fear has come back into the market around that point. We seem to be jumping between 35 VIX, very high, and 25 VIX, still very high. So remember this and keep this in your mind for later on today's video, the 25 zone. We'll watch that very, very soon. Another thing that's occurring, and it's imperative for this rally, for this to occur, that the US 2-year and 10-year need to continue to drop. This is the S&P 500 down here, this orange line, and you'll notice that the S&P 500 hates spikes in the 2-year. The spike of the 2-year, down we go. Obviously, at this stage, we're declining, up we go. That's what can happen. If we continue to decline here on the 2-year, it probably will lead to further rallying in the S&P 500. And I think that's something that a lot of people will be looking at out there. Keep that on your chart as much as possible. Let's move over to the US dollar index. This is still dropping. We are still in a 1-hour downward trend at this stage. New low formed overnight on the 2-hour chart here. And you'll notice it all happened over on this box. So really at this stage, the stop losses for most of the orders or the algorithms in the market should be behind here. And we're looking for the US dollar hopefully to continue down. Of course, a new low would be really fantastic for people that are hoping for the US dollar to go down, just because that would prove maybe a few points. One, maybe some money's going into bonds and growth stocks, or at least the stock market. And two, it might allow some opportunities on some pairs like gold. Now, by now, I'm sure you're all aware that the G7 banned Russian gold. Look, that's I already posted about it on Twitter. I think it's just not going to work. It doesn't work. We've already proven that with history. It's not really the best idea. Now, I just want to show you this because this is why you don't news trade, guys. The news came out on the weekend. It opened very bullish and suddenly started running. And then it dropped straight away and then ran back up. This unfortunately would have trapped many people that were trying to scalp and day trade into a position. I'm not saying gold won't go long, but in fact, I think it may go long off this level and we'll see whether it can. But the point is that if you news trade, you usually get hurt by the algorithms, by the market, and they tend to take advantage of those new little traders coming in and they take those stop losses. All the gap that was here has now been filled. We're back at our defended zone, which we've talked about a few times. We're not back at this level just yet, which is the 1810. But for this to really show us that it's ready to go, it needs to breach through this blue line here, 1846. Gold must get through that for us to feel a little bit more positive about it. US oil. Now, this is another interesting one. Look where it is, right at that previous distribution. It fell down. It came up in the previous session and broke through this level. Now, it didn't do a change of trend, and this is where it's important. For this to have changed trend, it would have needed to go underneath this level here. Now, for this to change trend as it stands on the smaller time frames, because we have a little bit of a trough here, there's a chance that underneath here would actually be quite significant towards the short side. Some people are choosing to stay away from oil at the moment due to the geopolitical nature of it. I don't blame them. We are at resistance, and this would be a perfect case where they could take a little bit of liquidity, get all the stop losses that are behind these orders, and then push it back down. So I think if you have patience, react, don't predict, there could be trades on oil moving forward, but you've got to be very, very patient for it. I'm looking towards the short, but at this point, obviously want to see more confirmation before making any of those decisions. Let's move over towards Tesla. Now, Tesla held pretty well in the stock market, I've got to say. If this stock market, that is the SP 500, we'll look at it a little bit later, actually moves towards the gap, this is the most likely scenario here for Tesla. And everybody's saying on the live stream, rightfully so, these are easy W patterns. And what they're saying is this, and it looks long. Yeah, they do, but the thing is they also have to get through these levels. And if you notice, even with this little double bottom here, if you take the distance of this area here and you extrapolate that out, it kind of comes to this level as well. So many stocks proofing towards these key critical resistance or supply zones that we're moving towards. And Tesla looks like it's on support ahead of the next session. It'll be interesting to see whether the market picks it up. Speaking of whether the market wants to actually buy growth stocks, XLY, XLP. A few weeks ago, we talked about how we believed that realistically growth stocks were being rotated into on the sly by the market. It turned out that was correct. Whether you looked at QQQ versus the SPY, XLY versus XLP, which is consumer discretionary and consumer staples, they all tended to point that way. But at the moment, it hasn't been that great in this indicator here, and it's starting to point its head down. I can also tell you that the bond indicators that I use, they are also saying that this rally kind of looks fake on the market for now. So this is not confirmed yet, but it's interesting. The higher we go, the more the bonds disagree with the market. That's going to be a critical thing that we need to be watching here over the next coming weeks. IWM, the Russell 2000, still jumping up, hasn't even got close to filling these two gaps. It's been lackluster, and I think that's why the last session it found stronger buying than the rest. The market went, you know what? IWM, the Russell, is behind everything else. While everything else is recovered, doing quite well, moving through the gaps, maybe it's time for us to buy this particular section of the market and hopefully pick it back up to fill the two gap zones that have been left. When you take a look at the rest of the market, you'll see what I mean. If we have a look at the DAX, pretty much any other market other than the US looks pretty poor right now. The FTSE, the DAX, and the ASX 200, this is the Australian market. All those ones with resources, financials, and of course, energy in general, they're just not doing well. Look at this, 2 shooting stars, very questionable here. We'll keep watching it, but it just doesn't look that strong in this market at this point. So we'll come back to that over the next couple of sessions. Now let's get into the US big ones. Let's go into the Nasdaq here. Downward trend here on the Nasdaq hit in the previous session. We talked about that. Not quite filled the full gap yet in terms of the upward side gap, but certainly hit the downward trend line. We've got some levels such as this one here, previous demand becoming supply potentially. The Nasdaq is at a pivotal point here in the markets and certainly a very interesting area, because if it breaches through here, is that saying to us that technology is ready to actually ramp here a little bit more? Or is it even showing us that the recovery is more real and we're ready for another month of movement? We'll watch this over the next session. An incredibly important trend line on the way down. The next thing that we're wondering is whether the market can come back down to this area and fill that gap. Now, it's left a few gaps behind, but this one seems the most logical for it to try to fill. And if it does fill, what a buyer is going to be doing here? They're going to be looking for turnaround stories on the smaller time frame, the 1 minute, the 5 minute, the 30 second, the 10-second chart, all these types of ones. They'll be looking for their systems to show them that buyers are more committed towards that movement up. And I think that's a pretty good area for some people to be looking at in the next couple of sessions. Who knows, we might even get there. S&P 500 tends to be the best of the indications during high VIX environments. The trend line for S&P 500 is actually a bit higher. Notice it's exactly in line with the gap. Very important. We filled the first one. That's a tick. Nice. First gap done. Gap left behind, island left behind down here, and all of everything in between. If the market falls off, will there be buyers here? I would think so. Of course, that gap being filled, you're looking for structure around that point. You don't just randomly buy it. That's like buying a falling knife, and you don't really want a falling knife to even catch it. That would be a bad idea. But if it keeps moving up and it gets through this little green line we'll look at now, so this is the previous level of supply, just here above 39.40, you would think that the floodgates become very open here for the market to be allowed to go to the next zone, which will be just above 4,000. Fill this gap, hit the trend line. Geez, that's going to be a big war between the bulls and the bears. You would think this is a very, very, very important zone for both of them. And I'm kind of hoping we see something like this. This would be very cool to have something like that. By the end of the week, we end there, go into the long weekend, get some reports out, find out what Wall Street's potentially doing under the hood. This will be a super pivotal, super interesting area. So watch the channel and we'll be following along on this level because I think it's pretty important. What do you guys think in the comments down below though? Let us know. Futures market action, you can see how it's coiling here a little bit. It's just trying to I guess, get a little bit of a base after such a huge move. Whether that base breaks all the way down and gets back into the gap, I'm not sure, or whether it actually breaches to a new high, takes out that level, and then of course moves on to the next zone, which we've got boxed here. We don't know, but both areas become quite tradable, and certainly having the patience to wait for the right position, the right area is what really separates many traders out there. And I think a lot of people in the comments will agree that having the patience to maybe not take trades until you see what you believe high probability zones are is super important. Let's move over to Bitcoin. Absolutely nothing going on here in Bitcoin. 20,700. Pretty crappy kind of level, really. It's not much going on. I would say that the 20,000 is an interesting zone purely because we saw previous buying here, previous buying. Maybe that's where you see a bit of a turnaround going on. That would be pretty cool. Other than that, though, there's not much going on in the crypto world at this stage. I did see Ethereum is slightly outperforming Bitcoin. So if you look at ETH versus BTC and you look at that as a ratio, you'll notice that Ethereum is outperforming Bitcoin at this stage and breaking through more towards the upside. But realistically, other than that, we're not seeing the big kahuna that is Bitcoin coming through with the goods just yet. It's still trading around the raw cost of the electricity, and I could see Bitcoin holding pat and staying here for a little while. If you haven't already, come and follow us over at FX Evolution, or of course join our public or private Discord, links in the description down below. And remember, the big news, this could be why the markets are moving around. On Tuesday, we have the CB Consumer Confidence Report. Then we have the OPEC meetings. Oof. Oil traders, beware, OPEC meetings, not good. The cartel comes out to let us know what's going on there. And then we have the trifecta. The euro, the pound, and the US, 9 a.m. New York time, ECB, BOE, and Fed Chair Powell speaking. That is the trifecta combo that I think the market's waiting for. So very important area. We'll find out what all of these places want to do. Possibly the ECB is going to continue to try to support the market the best they can. We'll find out very soon. Thanks so much for watching. If you enjoyed the video, please remember to subscribe, smash that like button, guys, and thank you so much for your support recently. We really appreciate it. See you soon.